Too soon to taper. Inflation rises, but the Fed stands firm. Jay Powell tries to calm concern about his policy approach. This is Bloomberg Wall Street Week. I'm Romaine Bostick, in for David Weston. This week, Professor Stephanie Kelton, author of The Deficit Myth on Economic Experimentation.
We are in an experimental economy, but after this crisis, we really saw fiscal policy engage in a way that it didn't after the financial crisis.
And special contributor Larry Summers on the continuation of trade tensions between the U.S. and China.
I hope there's some kind of ongoing channel so as to manage potential crises.
.4%. That's the stat of the week. It was the headline consumer price index number for June, and it was the strongest jump in inflation in more than a decade. You exclude food and gas, it ends up being the biggest jump in 3 decades. Even if you back out the cost of shelter and the cost of used cars, the remaining goods and services in that index rose by the most in 2 decades. That CPI report for the month of June left no doubt that the U.S. is battling a problem of rising prices. What is in doubt? Whether those inflationary pressures will be long-lasting or temporary.
It's clear that some of the inflation will be temporary.
Inflation has picked up stronger than I was expecting.
Now, critics argue inflation is being fanned by a Fed that insists on holding interest rates near zero and hasn't detailed when it's going to fully scale back those monthly purchases of treasuries and mortgage-backed securities. Lawmakers grilled Fed Chair Jay Powell, and he defended the current standstill on monetary policy.
Inflation has increased notably and will likely remain elevated in coming months before moderating.
And even as the economy seems to be roaring back, the Fed is still concerned that the pre-pandemic normal is not here yet.
While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue.
The spread of the COVID Delta variant is proof of the slow slog. It's now the dominant strain in Spain and in the UK, and it accounts for almost 60% of the cases right here in the U.S., widening the gulf between unvaccinated and vaccinated communities. And while the government central bank waits and sees, the big Wall Street banks show just how complicated things are in this economic recovery. Investment banking divisions, they're doing well, helping corporate clients adjust finances, but revenue growth on most trading desks, it's cooling as market swings subside. And while consumers are spending more and swiping their credit cards more, they're also borrowing less money to do so. Joining us right now, our roundtable, Invesco Chief Global Market Strategist Kristina Hooper and Bloomberg Intelligence Senior Analyst Alison Williams joining us here today to talk down about what happened really this week. And Kristina, we really have to start with that CPI data, followed by the PPI data, which seemed to ratify, the fears of a lot of people that inflation is certainly real. The big question here is whether it's transitory, and I'm wondering whether you at all got a little bit rattled by some of the data that we saw this week.
I actually didn't get very rattled at all, Romaine, and I'll tell you why. We have gone through an extraordinary period in economic history. We essentially shut down the economy, and then after a very significant period, we reopened it. So we have an incredible amount of pent-up demand. We have elevated household savings. We have lots of liquidity in general because we've had very significant fiscal and monetary stimulus. And so there is a lot of money chasing too few goods and services. Now, this print might be higher than what Fed officials expected, but they have said over and over again that they did expect inflation to spike. And I think that's key. This should not come as a huge surprise. Yes, maybe it's a little higher than most expect, but there's nothing that I've seen that changes my mind that this is likely mostly transitory inflation.
So for investors, does that mean that they should remain pro-risk, pro-duration?
Absolutely. I think what we need to do is take a step back and look at where we are in the economic cycle. And the U.S. really has just entered the expansion phase of the economic cycle. What we know from history is that typically that's a period in which risk assets outperform, and usually it's stocks that outperform risky bonds. So it's an environment that I think is a positive for the stock market. And I expect that monetary policy remains very supportive, even if we see the start of normalization. So to me, this is a time to be risk on.
So Alison Williams, a lot of people are really sort of trying to get a read here on where we stand in the economic cycle. This week, of course, we got earnings from all of the major U.S. banks here, and usually they kind of serve as a barometer, I guess, for economic sentiment. What did we learn from them this week?
I think we learned that the economy is very healthy, and to some extent we saw most of the trends that we saw were in line with our expected. A couple were a little bit outsized. So net interest income continuing to drift lower. Credit, super strong, great numbers from the bank, not just the reserve releases that we read so much about, but the underlying credit strong. And then
when you talk about the reserve releases, this is effectively the money they were setting aside for bad loans, right?
Correct. So if we think about the reserves, a year ago, banks had no idea, none of us had any idea how bad things would get. So they were very conservative in terms of setting money aside. As things are getting better, they're releasing those reserves, and that feeds into the income statement. And so there is a lot of volatility when you look at the overall EPS numbers. But I think from a core trends, also generally healthy, although, as I said, it's a little bit of a mix. So those banks that rely more on net interest income, like a Bank of America or Wells Fargo, some of the regional banks that are covered by Herman Chan, really have seen some softness. And a lot of that is really just due to the lack of borrowing.
Well, talk about that lack of borrowing here, because we heard that from Bank of America, we heard that from Citigroup. The idea here that consumers, and to a certain extent, I guess, corporations, aren't borrowing as much as banks maybe think they should be. Is that the case?
Well, not as much as they perhaps would like them, to be. And really what the banks need is for short-term rates to go up. But since we don't expect that to happen for some time, instead, what the banks really need to see is loan growth. And typically in the economic, at this stage in the cycle, we do see the pickup.
Right.
But in this case, because of all the stimulus and because of what we refer to as cash hoard, so consumers have about $2 trillion in excess savings.
Right.
Corporations have significant balance sheets. They don't necessarily need to borrow. So on the positive side of things, card spending, for example, across the four retail banks up about 50%.
Yeah, and that's interesting. I mean, we talk about the loan growth here. And Kristina, I want to bring you back into this conversation here, because while banks are sort of fretting about the lack of loan growth, we got some retail sales data this week that seemed to suggest consumers are still spending. They have money and they seem to be putting it to work.
They absolutely do. Again, we have seen elevated household savings levels. While this has been a K-shaped economy since the start of the pandemic, we have seen in general more money in households. Net worth has gone up, and as a result, there is more to spend, and there's a real desire to spend. So I don't think that this is a trend that goes away overnight. That's partially why we're seeing such a significant increase in inflation. But I do think at some point, spending will normalize to a healthy level.
So, I mean, we're talking on a day here where we saw bond yields on the benchmark 10-year yield really come down here. I mean, a few months ago, 3 or 4 months ago, we were sort of headed towards 2% and above here on the 10-year yield. We're ending the week well below where we've been over the average here, right around 1.3%. Similar story for the 30-year yield, which right now is camped out around 1.9%. What's the message being sent right now, Kristina, by the bond market? Because I would think in a reflationary environment, you would see a rise in bond yields.
Well, the bond market is going through an emotional spasm. Let's call it something of a tantrum. And I think there are some real fears out there, right? Because we do have the spread of the Delta variant, and that's causing concern. We're even hearing anecdotal information in the U.S. that is somewhat disturbing. Already, we're seeing counties like Los Angeles reimpose mask mandates. There's always a fear of greater stringency measures that could have an impact on the economy, both the U.S. economy and the global economy. Yeah. So that's one issue. And then the other risk, the other tail risk that I think we have to worry about in the back half of this year and beyond is that the Fed raises rates too quickly. That's the concern. Right, that it stymies economic growth. Yeah. But let's keep in mind that if we get the first scenario, right, the resurgence of the pandemic, we're not going to see the second scenario with the Fed raising rates prematurely.
Alison, real quickly here, just about 30 seconds here. What does this mean, though, for the banks? Because they are sort of reliant on an interest rate environment that in theory would be a little bit more favorable to them, one that I would presume would involve higher rates.
The steeper yield curve benefits the banks. Again, it's short-term rates going up are the main thing that they need, but a steeper yield curve is helpful. It helps the reinvestment rates, and it's generally good. But at the end of the day, it does come back to loan demand.
Any reason why we didn't see a stronger reaction in the shares? I mean, the bank shares sort of sold off this week despite some relatively positive numbers.
I think it's about costs, and that's really the one thing we're focusing on going forward. If you looked at the banks, it's operating leverage. So if you have weaker revenue, can you cut costs? And in fact, at many of the banks, costs are going up.
All right, our thanks there to Alison Williams of Bloomberg Intelligence and, of course, Kristina Hooper of Invesco. Coming up, Fed Chair Powell says central banks can still help get the economy back on track, but modern monetary theory experts like Stephanie Kelton say that holding down rates may not be the best way to manage inflation.
The best thing the Federal Reserve can do for the working people of this country is to, support the labor market.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm Romaine Bostick. The Fed jumped into action at the height of the pandemic and helped fill the gap while lawmakers came up with fiscal stimulus plans. But Fed Chair Jay Powell says it's still too soon to think about pulling back aid. Now, inflation is jumping and the Fed doesn't seem to be in any rush to raise rates. Modern monetary theory experts in that say that it's not just the Fed's responsibility. Fiscal policy should also play a role in controlling inflation. Stephanie Kelton, she's a professor of economics at Stony Brook University, the author of The Deficit Myth, and a leading expert on MMT. She joins us now.
When I look at the data, what I think mostly this looks like are the growing pains of an economy that's emerging from a pandemic and reopening. And we see a lot of idiosyncratic pressures and supply chain issues and backlogs and that sort of stuff. So I think by and large, what it looks like to me is the kind of thing that, frankly, we anticipated, right, coming out of the pandemic. And so it's pretty hard for me to see the kinds of things that I think you would need to be in place in order to get the sort of entrenched inflation that begins to feed on itself. So I guess I situate myself pretty squarely in the transitory camp.
Yeah, and there's certainly an element of the inflationary pressures we have that were certainly predictable, given just how volatile the economic crisis was, the COVID crisis, and how volatile things have been coming out of it here. But as we sort of get to the other side of this economic cycle, there's a lot of debate right now about additional fiscal spending, additional fiscal stimulus, whatever you want to call it. Is it just throwing another log on the fire of an economy that's already hot, or is this something that maybe has a place here in our policy and in the way we spend government money?
Well, I think it's the latter. I think that most of what we're hearing about right now, right, we're hearing about maybe a $3.5 trillion human infrastructure bill coming maybe alongside the more traditional so-called hard infrastructure. And I don't think the administration is thinking of this as stimulus. I'm certainly not thinking of this as stimulus. I'm thinking of this more the way I think they are, which is, doing things that will strengthen some of the fragility that's been baked into our system by, longstanding policy decisions. We're trying to redress some things, fix some of the deficits in the real economy, and lay a foundation for a really sustainable and inclusive recovery. So I think they're looking at this as an opportunity to strengthen the social safety net, make investments in things like education and healthcare, just places where we have underinvested for decades.
And we've heard that message, of course, from the Biden administration and some of his allies in Congress. We've also heard this idea here that sort of inequalities need to be addressed, particularly inequalities that were sort of laid bare based on the policies coming out of the last big financial crisis in 2008, 2009, 2010 here. What type of steps do you think that the Biden administration and hopefully Congress can sort of take so that we don't repeat some of those same mistakes?
Well, I think that what we're hearing articulated from the administration, right, is that the goal is to make investments at the bottom that grow from the middle out. So instead of, this sort of top down, trickle down sort of, policy prescription that we've tried again and again and watched fail, that this time is different, that this time we want to see the government making investments in things like early childhood education and the caring economy, broadening the scope for infrastructure investment, college education, elder care, and the rest of it. So I think, we're looking at the potential for millions and millions of good paying jobs, many of them for people, in fact, most of them for people with little, if any, college education. So this really is an opportunity to, provide a good, solid foundation for a recovery that aims squarely at those at the bottom and the middle of the economic income distribution.
So, Professor, you mentioned the sort of top-down nature of economic policy. That has been basically the dogma now for several decades. A lot of people have bought into it on both sides of the political spectrum. There's an argument to be made that there has been a spate of prosperity in this country that I guess can be attributed to that top-down policy. Is there a sense here that the boom-bust cycles we've been through over those last few decades since that top-down policy became the sort of dogma, that is a contributor to it, or is there something else here that maybe we should be looking at?
Well, I think there's something else. I think, the reality is that we've got a lot of studies now, and some pretty big ones that have been done, looking at the longer term effects of the supply side policies, and they really have been a failure. These have not been successful policies, and they've been tried decades upon decades.
And of course, this is a debate and kind of a generational debate here that you yourself are largely credited, at least with sort of pulling out of the wonky shadows of academia and into the public discourse, of course, with your book, The Deficit Myth. It's a conversation we're having, but you're actually now starting to see, as you just alluded to, some real implementation of some of these ideas, or at least an attempt to. Are you surprised by that? Are you surprised that we actually have folks in Washington that are willing to actually experiment with some of those ideas?
No, I mean, I think that we are in an experimental economy, and we started really in earnest with the experiments after the global financial crisis, when mostly central banks got very creative, and we saw a lot of experiments taking place there. But after this crisis, we really saw fiscal policy engage in a way that it didn't after the financial crisis. And so we have been experimenting. We've done things with payroll protection programs and expanded unemployment compensation and direct payments going out, not once, not twice, but 3 times. And so a whole range of bolder experiments. And I think we're just looking at an administration that has the sense that what they've been doing has been working. And if you figure out that you've done something that works, you want to keep doing it and do more of it. And that's what I think we're seeing. And so I'm encouraged by it.
Encouraged by it. And of course, we've seen, obviously, a lot of this is an outgrowth of the pandemic, just the need and the necessity to actually try some of these things that maybe wouldn't have existed had the pandemic not hit. When we talk about the Fed and its experimentation, because it has effectively shifted tone, at least, and to a certain extent practice in the way that it approaches monetary policy. Do you view that as lasting? I mean, Powell's term is going to be up soon. There obviously could potentially be someone new there. We know that not every governor on the Fed agrees with some of this shift here. Do you think that we could maybe revert back to some of the policies of old, which are still relatively entrenched in a lot of economic circles?
I suppose anything's possible, but at this point, I think the reality is that we have a Fed chairman who has been very candid about the importance of tight labor markets. He has said time and time again that the best thing the Federal Reserve can do for the working people of this country is to, support the labor market, to allow unemployment to move lower, to get the labor market to run hot. And when Chairman Powell says that he's laser focused on restoring economic opportunity for those who are looking for work and still haven't found it, I think we ought to take him at his word. And I think that it's going to be pretty difficult for a future Fed chairperson to, in a sense, reverse that policy and say that we're going to, in some sense, demote the importance of full employment.
One of the criticisms that Jerome Powell faced this week before Congress. One of the criticisms lobbied at the Biden administration. One of the criticisms also lobbied at you and some of the other economic thinkers who have embraced MMT is this idea of government overreach, that once we go down this path, it provides or it gives the government a certain amount of control and a certain amount of influence that a lot of folks don't think the government should have.
Well, a lot of folks want the policies that are being put forward by this administration. They are overwhelmingly popular, and they're popular on a bipartisan basis, right? So it isn't, MMT doesn't give Congress any new powers or authorities. They already have the power of the purse. They already have the ability to write and pass legislation as bold as they might choose to do. The reality is that for too many years, I believe Congress hasn't really taken advantage of the fiscal space that's been available. That's been damaging to all of us, right? Bad policy harms all of us. So we end up with an economy that underperforms. We end up with fewer jobs than we otherwise could have had, with less prosperity. So I think to the extent that Congress is waking up to a new way of thinking about the way it approaches the budgeting process and the use of fiscal policy to help support the economy, is going to end up being a pretty good thing for most everyone in this country.
Our thanks to Stephanie Kelton of Stony Brook University and author of The Deficit Myth. Coming up, we take a look at the week ahead on global Wall Street. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm Romaine Bostick. It's time now for a look at the week ahead on global Wall Street.
Romaine, we are counting down to the Tokyo Olympics as Japan seeks to contain new virus outbreaks. This past Friday, the BOJ trimmed its growth forecast for the year, but the central bank did lift its outlook for 2022. Indonesia decides monetary policy on Thursday as the country accelerates vaccinations to manage rising COVID cases. Daily infections in the country surpassed India in the last week. And when it comes to China, the update on loan prime rates will be of more interest than usual after the triple R cut. Some analysts, though, say it's too early to call the start of a new easing cycle. Danny?
Thanks, Sophie. On Monday, most COVID restrictions will be lifted in the UK despite a surge in coronavirus cases. Then on Thursday, we have an ECB rate decision where they will be incorporating their new inflationary target. Taylor?
Thank you, Danny. A big week first with economics. You've existing home sales and new housing starts. That's going to be key as this housing market has been on fire, but you've had a lot of supply constraints as well. So that key data is really going to give us a read on the housing market. Pivoting on over to earnings, let's start with Netflix. Going to be a big week. We're actually looking at a pretty weak quarter for Netflix, but they are going into video games to help deepen some of that consumer penetration. So that's going to be a key as we take a look at that streaming service. Finally, it is all about that reopening trade. We're taking a look at United Airlines and American Airlines also reporting next week. One of the key issues is we know that consumers have been flying domestically. We hear that Biden's trying to open up the European travel. Can they start to get those long-haul flights? That is going to also be something that we're waiting on for those earnings reports. Romaine, that's a look at what we're watching.
All right, our thanks to Sophie, Danny, and Taylor. Coming up, Netflix is adding a new wrinkle to the streaming wars with a plan to offer video games alongside Bridgerton. We talked to former CNN President John Klein about the fight to stand out in the streaming world. That's next on Wall Street Week on Bloomberg. The lockdowns of 2020 boosted Netflix, but next week, investors will get a chance to see whether the streaming giant's growth will hold in the post-pandemic world.
We saw a dramatic pull in for their subscriber growth. The bump was enormous. You can't sustain that, obviously. The question was, when would that slow down and how dramatically would it slow down? Well, now we have the answer.
The key number to watch will be subscriber growth. A Bloomberg intelligence analysis of Sensor Tower data suggests global demand for Netflix is moderating, with the number of downloads in May and June rebounding a little from March and April, when reopenings took a toll on adding new subscribers.
Netflix has done better than I think many people thought in terms of adapting to a few things. One, the competition from Disney and AT&T and others, to international expansion, which is something they invested heavily in.
Disney Plus is Netflix's most formidable rival, but the streaming service still has a lot of catching up to do. Disney Plus had 103 million global subscribers. That compares to Netflix's 208 million. Disney Plus has a strong presence in Europe and in India, where it carries streaming service Hotstar. There's a new Marvel series, Loki, which debuted on Disney Plus last month, and that may have given the streaming service a last-minute subscriber boost for the quarter.
Our sign-up growth continues both domestically and internationally, and I have to say that we've now launched in a number of markets, I think 59 markets across the world, and we've not been disappointed yet.
The streaming world is expected to get even bigger. A new PwC report predicts streaming is going to generate $94 billion in revenue by the end of 2025. That's up 60% from 2020. The pandemic brought new entrants into the streaming wars with the launch of NBC Universal's Peacock and Discovery Plus.
I think there's only a handful of truly global, greater than 100 million subscriber base type of services that can exist.
All right, Netflix setting a high bar for its competitors, of course, with that TV and film content. Now the streaming giant said to be expanding into video games. Joining us right now, John Klein. You know him, of course, as a former president of CNN. He's now the co-founder of Hang Media. He knows a lot about keeping eyeballs glued to the screen. John, even before this announcement here about the foray into video games, we had seen Netflix experiment with live events and merchandising, a lot of things that are more than just the content of watching a television show or a movie here. Is this the future of streaming? This is what it's going to be?
Oh, it's the present of streaming, because streaming has become the central entertainment activity for everybody. COVID helped accelerate that, and that trend is not going away. Wait until they start getting into AR and VR. And, there've been a lot of experiments with that already, but that's all going to be filtered through your streaming service as well. So there's a lot more to come.
So what does that mean, though, for some of these smaller streaming services? I saw a statistic saying that, as of last month, there were almost 200 streaming services available here in the U.S., some of them obviously very niche. And then, of course, you have the big players like Amazon, Apple, Netflix, Disney Plus here. Is there room for a niche service that is just maybe doing one small thing?
It's really tricky, because one thing that we've all seen in the past year is that streaming is an incredibly expensive business to be in. Disney just announced that they're going to be spending $30 billion a year on content for Disney Plus. And they thought they were going to be spending about half that. And they've realized that they have to seriously up the ante, because you think about your own streaming habits. You can binge an entire season of a show in one night if you're really into it. And these services are all having to scramble to catch up to make sure that they're shoveling enough content onto their services. That's why you've seen Netflix add so many foreign produced shows. I mean, I'll bet you've watched at least one Netflix show that had subtitles in the past year, right? And that's because they just kind of ran out of US created content, partly due to COVID and partly because consumer habits are just out of control. And it's going to take a lot of resources to catch up to that, which means that smaller niche players are going to have to, double down on the ultra niche and over deliver on their customer acquisition tactics so that the cost of acquiring a subscriber drops to make up for the increasing cost of content. But it's going to be tough. Think of it this way. The tech companies have so many more resources to deploy against content costs than traditional media companies do. Apple alone has a higher market cap than a combination of Disney, Netflix, Comcast, Verizon, and it's so they can enter this business whole hog, and they've barely begun to fight at Apple. And so it's going to be a very expensive proposition to be in the streaming business.
Given the expense of that proposition, do you anticipate any sort of meaningful consolidation?
I think there's going to have to be among the streaming also-rans or the smaller players. I mean, it just isn't going to make sense to some of these companies to spend the kind of money that's necessary. For example, if you're NBC Universal and you're planning to spend $17 billion this year on Peacock, you might pause and say, well, first of all, where's that going to come from? We're going to have to cannibalize some of our other core businesses, and they're going to have to be willing to do that. And will they be? Will they pull money away from the TV networks, from the local TV stations that they've got in order to fund this? Or might they say, you know what, maybe we ought to pair up with somebody like a CBS or Warner? Should Comcast jump in to the bidding for Warner Media and grab that away?
Well, that raises an interesting question here about the future of live television, John. Obviously, you ran CNN for several years here in the U.S. here. And I'm curious, is there still a place for live news, live sports in a streaming world where we want to see everything on demand?
Well, news is one of the few areas that's actually growing during the streaming boom. And I think it'll continue to, because it's just a very tough proposition to watch news later, on demand. You do want to see it as it's unfolding. Sports is going to evolve because it used to be, and has been up until now, a mainstay of traditional television delivery. But Amazon just paid $1 billion for the rights to Thursday Night Football starting in 2023. That's a first for a streaming service to pay that kind of money. So, that is a bellwether for a big change, and I think you're going to begin to see sports go the pay route as well.
Yeah, a lot of money, and of course a lot of eyeballs and a lot of companies vying for a piece of that action. John, really appreciate you being here on this program. John Klein, of course, he is the co-founder of Hang Media and the former president of CNN. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg. And now here to discuss some of the economic developments of the week, we're joined by our special contributor, economist Larry Summers. Larry, I want to start with some developments that occurred towards the end of the week. On Friday, we got an advisory out of the Biden administration, the Treasury, the State Department, the Homeland Security Department, and the Commerce Department, all putting out an advisory warning U.S. companies about the risks of doing business in Hong Kong, saying the business environment over there has deteriorated given China's recent push to, control what goes on in that territory there. The relationship between the U.S. and China, the economic dialogue between the U.S. and China seems to be getting worse, not better.
I think that's right. I think there are plenty of issues on both sides. You look at many of the things that China has done. It's not just vis-a-vis the United States. The investment agreement that China and the EU had reached are on the rails. China's encountering friction all over the world. I am concerned about the canceling of dialogue. It seems to me that in many ways, the more fundamental your disagreements, the more important it is that there be some form of communication. So I don't think we're in any position to have a partnership with China. We're competing with them in very full spectrum ways, but the strategy of not having dialogue and not being interested in communication, it seems to me, is one that concerns me. And whether it's called a strategic economic dialogue, whatever it is called, I hope there's some kind of ongoing channel so as to manage potential crises and so that we're in a position to address difficult issues when and if they arise. I think we need to recognize that we're in a kind of unprecedented situation. When we were in a significantly adversarial relationship with the Soviet Union, there was vastly less interdependence than there is today. And so with this degree of disagreement, this degree of interdependence is a new kind of relationship, and we're all feeling our way. And I'm not counseling us to not aggressively pursue our interests. I think we do need a kind of firmness and directness that we always haven't had. But I do wish we were providing for some continuing conversation.
What's your general view here right now on where we stand with these inflation pressures?
I think most of the observers are framing the question the wrong way, Romaine. They're framing it as, is inflation transitory? Look, at an annualized rate, the inflation rate was 11% this month. Yes, that is transitory. There is no question at all that that is transitory. There is no question that the figures were pushed up by transitory factors in used cars and other things. But that's not the important question. The important question is whether of the 11%, 9% was transitory, 8% was transitory, or 6 or 7% were transitory. If 6 or 7% was transitory, then we've got inflation running at 4 or 5%, and we've got a real problem in the country. So one's not addressing the issue usefully simply by remarking that there's a lot of transitory inflation. You know, when I'm here on Cape Cod. When it's foggy at 7 in the morning, you can believe that it's all going to have burned off by 8:30. When you get to 9:30 or 10 and it's still looking pretty foggy, you start wondering whether you're going to go swimming that day.
Yeah.
And I think that's the kind of situation we have with respect to inflation. I grant you that it's a big surprise that this hasn't shown up in the bond market yet, but I think at some point it will.
Yeah, it's a great analogy there, Larry. I'm just curious here quickly. I mean, there's certainly a disconnect between what we see in the data and some of the anecdotal evidence that we're getting on the ground. The Biden administration is scheduled to meet today on Friday at the White House with representatives of the home building industry to talk about some of the housing price pressures. There was a report earlier this week that you yourself also was at the White House to discuss, I guess, potential economic issues. Are you willing to divulge what was discussed?
No, Brian Deese and others in the White House are longstanding friends of mine. I was in Washington to visit my in-laws, and we had a longstanding plan for me to come by. But it's always been my policy, as you know, Romaine, not to talk about the private conversations I have with public officials. So I think I'll leave it at I had a good visit with my in-laws.
All right, and one final question here, Larry, before you go. That infrastructure package, it looks like it is working its way through the Senate right now. Of course, the two parallel packages, that $600 billion package, and of course that $3.5 trillion package as well. Are you confident here that at least where it stands right now, that it will make it through intact?
That it will make it through intact? No. I'm sure that we have not seen the last amendment. I'm sure we haven't seen the last set of political challenges, but I think it does look like the far and away most likely thing is that President Biden will have a remarkable achievement in terms of social and physical investment in renewing our economy. What's very important, and the administration recognizes this, is that it be focused on measures that will expand the supply side of our economy. That will help to contain inflation as well as to prepare us for the future. And that's everything from repairing roads so the traffic flows better to supporting moms so that they can stay in the labor force. That's everything from facilitating the adjustment to a clean, green economy, to doing necessary steps to control and contain the costs of pharmaceuticals. I think the broad directions here are right and hugely important, and to have achieved it at the same time that we're containing COVID and working with such a narrow majority in the Congress, I think is a tremendous credit to President Biden and his team. We're not there yet. There's a lot left to work out, but I'm excited and encouraged by what's happened. But a lot of the devil's in the details, and those are going to need to be worked through going forward.
All right, Professor, we're going to have to leave it there until next week. Of course, economist Larry Summers. Coming up, SPACs. You love them, you hate them, they're here to stay. That's according to Apollo CEO Mark Rowan.
Absent significant regulatory change, I think you will continue to see a thriving SPAC market that will go through cycles of capital being plentiful and capital not being so plentiful.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm Romaine Bostick. Finance is seeing a wave of democratization, and Wall Street is finally coming to terms with that. Retail traders, they're finding more opportunities to participate alongside institutional investors, and that's thanks to platforms like Robinhood. Bloomberg Quick Takes Jason Kelly sat down with Apollo CEO Mark Rowan to talk about the tides turning on Wall Street.
You have on top of this like amazing, mix. You have technology and technological change, and you have fintech, and you have this democratization of finance. I mean, if it doesn't, the thing that strikes me, think about it, millions of Americans sent their money to a place called Robinhood to trade complex options and other products. I don't mean to say anything negative, and I'm not positive nor negative, but it just struck me that if that's not a sign that the markets are moving and the markets are changing, all manner of fintech companies are gearing up to provide the kind of services that have been historically been provided by traditional investment firms on the one hand and banks on the other hand. Some of those firms will have balance sheets. Some of those firms will not have balance sheets, and they will partner with people like Apollo, who will be their balance sheet.
Right.
So how this whole realignment takes place, I can't tell you. I believe it will result, as I've said, when I say democratization of finance, I don't just mean on the retail side, the high net worth side, I also mean on the origination side. The financial crisis in 2008 pushed a lot of activities out of the banking sector and into the non-bank lending sector. Some of it for good, some of it for bad. It's a wide-ranging debate, but it's happened. And those activities, I believe, are going to continue to take place outside the banking sector as credit formation increasingly is done with investors who have matched capital to provide this. So we're in a really interesting period of time. It makes it incredibly exciting to come to the office each day. It also means the culture needs to accept this.
Yeah.
And part of my job is to prepare the culture to accept it, to make sure the speed of decision making accepts this.
And you mentioned Robinhood, which I think as we look back, at least through a financial markets and financial services lens, will be one of the legacies of this tumultuous period. The other one likely will be, for those of us who lived through it, the SPAC. Something that just sort of burst onto the scene, now seems to be receding a little bit. How did you sort of assess that in the moment, and what does it tell us in the broader scheme about kind of the function of capital markets?
Look, I think we're watching financial innovation. Absent significant regulatory change, I think you will continue to see a thriving SPAC market that will go through cycles of capital being plentiful and capital not being so plentiful, which is kind of where we are right now. But we're in a history of financial innovation. I mean, if you look at this from the start of my career to today, and you look at the products offered by a traditional mutual fund, it was pretty vanilla. Go look at the offerings today. It's like this. There's an encyclopedia now. SPAC is another form of financial innovation. It was a way for a growth-oriented set of companies to access capital markets in a much faster, much cleaner way than a traditional IPO process. You have that along with direct listings, which a number of technology companies have undertaken. I think the SPAC ecosystem is here to stay. Maybe not at the same size and scale. We have been beneficiaries of the SPAC ecosystem. We view it simply as an extension of growth investing.
That was Mark Rowan, CEO of Apollo. Now finally, one more thought. Next week, it's the 52nd anniversary of the Apollo 11 mission to the moon, a human setting foot on soil other than the Earth's. It was a dramatic culmination of a years-long space race between the Soviets and the US. And while rooted in national security and national pride, of course, it ended up being a springboard for technological advancement. A third industrial revolution that hastened the development of automation and computing, and it laid the groundwork for many of the things we take for granted today. Mobile phones, food preservatives, air purifiers, cordless tools, wireless headsets, memory foam, and so many other little things that were all owed directly to one big thing, the push to explore space. That push then was led by government agencies. But now we're in a new era of space exploration, and it's being led by private industry and private individuals, Bezos, Branson, Musk, billionaire entrepreneurs whose ambitions, dare I say, may be a little bit less noble and much more profit-oriented than what was spawned back in the 1960s. But once you dig beneath that billionaire bravado, something important really is taking place here. Real science, real research, real human progress. It's likely no coincidence that Bezos chose to stage the first crewed mission of his Blue Origin spacecraft for July 20th. That's the anniversary of Neil Armstrong's milestone. Bezos has already compared the spectacle of space tourism to the airplane barnstormers of 100 years ago, whose flying acrobatics seemed trivial at the time, but they really did help fuel public fascinations and acceptance of a new and now, of course, common mode of transportation, the airplane. Elon Musk and SpaceX, they've shown you can shave millions of dollars in costs off of a launch by reusing rocket boosters. This was an idea that was nothing more than science fiction just a few decades ago.
SpaceX is the apex predator in the space market. Some would argue they're sucking the air out of the universe right now in terms of talent and capital.
The experimentation by these individuals, along with the continued involvement of NASA in the US and the space agencies in China, Europe, India, Russia, and the UAE, they're actively leading to scientific advancement in jet propulsion, mining, farming, water extraction, laser communication, and radiation shielding, all providing valuable insight into how humankind can adapt to much harsher environments. Now, it's unclear what the end game is for this renewed push to explore the ultimate frontier. But if the 1960 space race was any guide, then the sky is not the limit. That does it for this episode of Wall Street Week. I'm Romaine Bostick. This is Bloomberg.